So the taxation of divorce is going to be split up into two different parts. We are going to be discussing termination of marital status, child custody, child support, alimony, and property division. So stay tuned for the next episode, which will be linked below. But to no further ado, let's start talking about termination of marital rights. Let's get started. So when it comes to getting a divorce, you can do what's called bifurcating the divorce, meaning that you can split it into two different parts. You can actually terminate your marital status while at the same time holding on to the remaining issues such as alimony, who gets the kids, etc. for a later time. Number one, you can stop any of your spouse's debts being yours, and number two, you can finally get that first stage of separation. At this point, once you bifurcate, you get to get the single taxpayer status as either single or as head of household. But even if you bifurcate the marriage, there are some issues with community property, in that if you do not meet all of the following criteria, you may still have to have community property on both sides of the return, both yours and your ex-spouse's. So number one, you have to have lived apart for the entire year. You have to have not filed a joint return for the tax year. You and your spouse earned community property, which was in the last episode that we discussed, and that there were no transfers of earned income from community earned income between either spouse. So if you and your spouse are separated but don't meet these four conditions, you must treat your income according to the laws of your state. And so in some states, income that is earned after separation but before a degree of divorce continues to be community income, but in other states it is separate income, which is why in a lot of cases you want to bifurcate your divorce to get that single status, that separate status. So now let's talk about the three types of tax return filing status that you can file as in the year of divorce. So in the year of divorce, that is when you can claim that you are single. Now, single being that you are not married and you have no dependents. You can also claim that you are head of household. So as a head of household individual, you must be single. You must provide more than 1/2 of the cost of maintaining the household, that you provide the principal home of a qualifying child or dependent relative, and that child must live in the house for over half the year. Now, whether you are a qualifying child or a dependent relative, you must meet the actual relationship test. You can't be living with the taxpayer for the entire year relationship test. Now, there is an exception, that of an unmarried child. That child need not be a dependent if the custodial parent gave the dependency exemption to the other parent, and we'll talk about that later. Now, if you have not finalized your divorce, but you are separated, you can file as married filing separately, where each of you reports your own income, exemptions, deductions, credits, and taxes paid. But if either spouse itemizes, the other spouse must also itemize. And if you file as married filing separately, you cannot claim the credit for child and dependent care expenses or the earned income credit. Also, if you're in a community property state, you must report 1/2 of all the amounts that were earned by the community or the married couple. Now moving on to custody, let's talk about personal and dependency exemptions. Now, in 2018, the rules is a little bit different in that with the new tax act that was just enacted at the end of 2017, 2018 no longer has dependency exemptions or personal exemptions. You only get one super standard deduction, or you can take your itemized deductions if they exceed your standard deduction. Now, with that being the case, dependency exemptions are no longer an issue. Let's talk about what the dependency exemptions are. Everyone gets their own personal exemption of $4,050 for 2016 and 2017. So if someone else can claim that dependency exemption for that individual cannot claim his own personal exemption. Instead, somebody has just stolen that personal exemption. If you are filing separately, married filing separately, you cannot claim your spouse as a dependent unless that spouse has no gross income, didn't file a tax return, and is not claimed as a dependent by another taxpayer. So there are two rules for establishing whether or not someone is a dependent, that being the qualifying child test and the qualifying relative test. We did go through an in-depth discussion of these in episode 11. So for more information, please check episode 11 for how you determine whether or not you can claim somebody as a dependent, whether that be as a qualifying child or as a qualifying relative. There are, however, special rules for divorced parents. That being that the parents must provide more than half the support of the child to be able to claim that dependency exemption, and combined, the child must live with one of the parents for more than half the year. The general rule is that the Internal Revenue Code presumes that the custodial parent should receive the dependency exemption. But there is an exception. The non-custodial parent gets the exemption if the custodial parent signs Form 8332 or Release of Claim to Exemption of Child of Divorced or Separate Parents, or this divorce occurred prior to 1985, awarding the dependency exemption to the non-custodial parent. Now, this is very important because if the Internal Revenue Code says that the custodial parent gets the dependency exemption, the lawyers and the judge cannot just unilaterally say, oh, the non-custodial parent is now going to get that dependency exemption. And this is why. The tax court has held that regardless of what the divorce decree says, the non-custodial parent will not be allowed to take the exemption without the written waiver by the custodial parent. State courts, by their decisions, cannot determine issues of federal tax law. Now, even when Form 8332 is signed, giving the non-custodial parent the right to take the dependency exemption, that non-custodial parent cannot file as head of household, but may receive the following benefits: the dependency exemption, the child tax credit, as well as the Americans Opportunity or Lifetime Learning credits, which are educational expenditure credits. Now, each state has different rules as to the preference of who gets the personal exemption, but you need to see an attorney in your state to determine what is best in your state and what is going to be the best situation for you. Practice tip, however, it is an abuse of discretion for a divorce court to order a custodial parent to sign the tax exemption waiver in the absence of appropriate findings that the non-custodial parent is current on his child support payments. It cannot be known in advance whether or not the non-custodial parent will be current on his support payments, and thus the parties must agree that the custodial parent sign all the waivers at the time of the divorce. Another practice tip is that there can be a provision in the divorce decree allowing a former husband to buy the income tax exemptions for the party's minor children. And how this works is that at the beginning of the year, both parties calculate their tax that would be owed with and without the dependency exemption, and the husband then pays the difference to be able to take the dependency exemption, because typically the higher earning spouse will benefit more from the dependency exemption than a lower income spouse. All right, so now let's go to child support. Child support is, number one, non-deductible by the payor. It's not included in the income of the payee. And why is this? Parents have an obligation to provide for their children. So one spouse who must pay child support because they earn more than the other spouse doesn't get to deduct that child support because they had to pay it anyways. However, to include it in the income of the person receiving that child support would be double taxing it. Therefore, it's not included in the person receiving the child support because the person paying it had to pay it anyways. There's only a lump sum amount of child support that is obligatory under most state codes. Now, if an amount of alimony reduces upon the happening of a contingency related to the child, the amount is child support. So, for example, if the divorce decree states within 6 months of turning 18 or of turning 21, a certain amount of alimony is reduced, that certain amount is now considered child support. Now, gross income is used in most states for the calculation of child support. However, the courts have indicated in some regions that net income should be used for the calculation of alimony. So it depends on your state. Again, see an attorney if this is something that you are trying to figure out in your jurisdiction. So with that, we are going to pause this discussion of the taxation of divorce and leave alimony and property settlement to another episode. Thank you so much for watching. If you have questions, please leave them in the comment box below, or you can email me at centerfortaxstudies@gmail.com. Thanks so much for watching. Subscribe and like this if you did, and we'll see you next time.